Welcome to the Clear Skies Retirement Podcast with Jay Kirkwood of Secure Financial Management. We all know that in October, that's, market nightmare time. That's when the crash of 1929 took place. That's when the 2008 financial crisis took place. We all look at October. But if you look at market history over the last 75 years, the month that has the most volatility in it is where we are right now. It's in September, which is kind of interesting. But then if you start to look at some of the other stats out there, in the fourth quarter, 80% of the time, the market goes back up again. So I wanted to ask about stats and market history and stuff like that. Do you use that as a guide when you sit down and talk to people and talk about their planning? Or do you say, look, 1980 was a long time ago. 1970 was a long time ago. The market back then isn't even close to what the market is today. So a lot of that stuff just doesn't apply. Or do we use market history? Talk to me about that.
Yeah, I think you need to be very careful when looking at this sort of data. The wonderful thing about statistics is you can get them to say whatever you want. All right, you kind of tell me what do you want to show, and I can show you the statistics to back that up, right? What concerns me with this sort of thing is this is really looking at kind of, well, this month is typically down, this month is typically up, we should invest. That's basically market timing. That's basically what you're trying to do, okay? And anybody who tells you that they can time the market is lying to you. All right, it doesn't happen. Can you get lucky once or twice here and there, buying at the bottom, selling at the top, getting in and out just at the right time? Yeah, you can, but it's not a long-term solution. And that's really what you're doing here is if we're going through, we're saying, man, there's been some pretty bad corrections in October, the start of the financial crisis, 1929, like you said. I think the 1987 crash was also in October.
That went down 20-some% in a day.
Yeah, you could look at that and be like, what's up with October? I'm just going to get out of here for that, right? And it goes really to the bigger problem of market timing. And this is what it is, right? This conversation will kind of come up when, whenever the markets aren't doing that well. 2022, okay, not a great year in the markets. And as financial planners, as investment managers, you manage wealth the best you can. The markets are the markets, right? You've only got so much to work with that, and you do your best you can with it within those parameters. And we'll have clients say, well, let's just get out of the markets until everything calms down, and then we'll get back in. And I say, hey, you're the boss. We work for you. We're going to do whatever it is you like, all right? This is the deal, though, if we do that. You've got to tell me when that day is that everything's okay. It's a great feeling to get out of the markets when things are rough, right? If you think a bad month is coming up, it's great, right? The problem is you will have so much anxiety and uncertainty about, well, when do I get back in? Because you're not going to get that bottom. You're just not, right? Like I said, can you get lucky once or twice? Yeah, it's not going to be a recurring theme. So then you miss the bottom, the market rallies. Well, I can't get in now. I mean, the market's gone up 10% and I missed it, right? I've seen people that have come into the office this year and they're all in cash. And I mean, big accounts, $1 million, $2 million accounts, all in cash. I was like, what happened here? And it's like, well, I was managing the money myself or whatever was happening, right? But in 2022, I just got real nervous. And so I got out of the markets completely. And then, we're up whatever it is, 20%, 30% since then. Well, now I don't know what to do because the market's so expensive. Am I getting back in and I'm going to, it's going to be another downswing? I get it. That's the difficulty. And that's the corner you paint yourself into when you try and pore over statistics and really, if we get to the crux of it, try and time the market.
Yeah, I heard a financial advisor one time say that the market's never been down in its history 3 years in a row. So if we had 2 down years and you decided to push all in, then we finally break that mold and we're down 3 years in a row, and then you lose about it. Yeah, exactly. Right. I hear what you're saying.
Right.
And that is the fallacy of the whole deal of going to cash and then coming back in. Trying to do that is so very difficult, and nobody has been able to figure that out. So the idea then would be to stay invested to a certain point that you're comfortable with. If you lose money, it's not going to kill you. If you lose money in a bucket, that's not the bucket you're using, as Jay would say. say an awful lot. But then when you look at the market this year, it's been a really good year. I mean, it really has. So you're probably looking at your 401k right now or wherever your investments are, and you're saying, okay, that is as high as I've ever been. So now what do? Do you say, okay, I pull back? Do I take some profits? This is a wealth manager named Sandra Cho. She's talking to the people at Yahoo Finance, and she said this might be that time.
One of the best things to just know in your heart is that there is going to be volatility in the markets, and to accept it and then just lean on that diversification. If you've been in the Mag 7, if you've made that play with the AI stocks, good for you. There's been a huge run up. That said, at what point do you start taking those chips off the table and cashing them in?
So that's a little bit of timing there as well, but not the same thing. So I have a profit. When's the best time to take a profit? When there is one. So, Jay, there is a profit right now. Do we look at retirees or people close to retirement? And this is that risk conversation and say, okay, let's pull some of that off. Not all of it, but let's pull some of that off and put it into the safe category for a rainy day, which we call retirement.
Yeah, it's definitely a strategy. And I think to dive into this concept and what Sandra is talking about there, when we've had these big runs, and they have been fairly concentrated in a handful of stocks or a certain sector of the market, is our portfolio really aligned the way that we intended to? And what she's saying here is it's not, right? Because NVIDIA is the hot topic to talk about right now, right? With their AI chip manufacturing and the run that they've had. It was funny, I was listening to a story on Bloomberg the other day when I was coming into the office, saying that a lot of the other tech companies like Google and Facebook, the employees are jealous of the NVIDIA ones because a lot of their comp is stock option based, right?
Okay.
And so if you look at the NVIDIA parking lot there, it's just Maseratis and Ferraris and Lamborghinis, because you got these guys that just, they started with stock that was worth, whatever it was, and now it's 1,000 times plus that. But take that as an example, right? You always want to be careful how much you would put in any one company, right? Not knowing what's going to happen. I mean, now that we know with NVIDIA, do you want to go back and put 100%? Yeah, well, now you do, now that you know what happened, right? But, it's very rare that you'd want to do something like that in the onset. And you might say, hey, I think there's potential to grow NVIDIA, right? It's volatile. It's a company. Let's not put everything we have in there, but let's put 5% of our portfolio in there. Let's just say that's the scenario that we do. Depending on when you did that, if you did that a couple of years ago, maybe NVIDIA is not 5% of your portfolio. Maybe it's 30% of your portfolio now because of the growth that it's had.
And you didn't do anything. You didn't rebalance or anything like that. It just grew
changed.
That way.
So now what's really happened is that risk level in our portfolio, and what we call this specifically is concentration risk, right? A huge amount of our future success is now tied to one company, in that case, NVIDIA, right? Should we probably peel some of that off, put it into other sectors, maybe guarantee some of it, whatever you might do? Probably that's a good idea. And I think that's the point she's trying to make here, is that should we take some profits? Yeah, maybe that's a different kind of discussion as well, though. Is our risk tolerance really being followed? Is our portfolio acting the way that we want, given now that it's so out of whack?
Yeah, this is a conversation when you do your analysis of a 401k even, where you have, allocated your money, or if it's not a 401k, if it's your own portfolio that you're having managed, and take a look at the different sectors that you're in. Because I work with you, Jay, people come to me at work and say, okay, Randy, what should I do with my 401k? And I'm like, what are you doing to me? And, so you look at all of those different things there, and there are some funds that'll say it is an energy fund. It's a tech fund. You can get into a different sector. And so if people did push into that tech sector at the beginning of all this, and those Mag 7s just made their portfolio go way up, maybe it's a sector rotation at the same time, and that's going to be a risk conversation as well. When you do the analysis for people, do you find people are way overweighted in some areas because simply that's what's working right now? Yeah,
and what kind of compounds that is Yeah, I know we had 2022 as a down year, but really, if you go back the last 15 years or so, 13 years maybe, the markets have been really good to investors for a long time, right? 2022 was rough, but from 2010 until 2022, I would say you really didn't have. You might have had one down year, and it was a very mild down year, right? It wasn't significant. Things have been very good for a long time, and the concern that I have for the public in general, right, especially those close to retirement or just moved into retirement, is the thought that that's always going to be the way. And history says that that's not the case, right? That the markets don't always go up. The last time that I can remember, maybe 2008, 2000, but the clearest one in my mind, if we go back to back down years in the market, it's early in the 2000s. After the dot-com kind of bubble broke, and we had, back-to-back negative years. And it's been a long time since anyone's experienced that. And I have a big question mark over the risk level that people really feel that they're comfortable with. And I think there's been a bit of a false sense of security tied into that. So that's why the planning becomes so important, right? It says, hey, do we want to be out of the markets? Do we want no growth? No, we do want some of that. Let's just make sure we're not all on red, right, when we're investing like that.
It is interesting that you could go out there and try to find somebody to help you with your money. A young financial advisor may have been in middle school during the 2008 crisis. He or she may never have experienced a 30, 40, 50, 60% decline in the market. They saw COVID, and it went down 30%, but it bounced back so quickly. We didn't bounce back that quickly. It took me 5-6 years to get back to even after the 2008 subprime mortgage crisis. And so a young advisor right now may not have experienced that at all. Jay has experienced that. So have I, and so have you. It's time to talk through it. It really is. We don't want that to happen to us early in retirement or at all in retirement. So having that idea of risk rebalancing and moving away from some of that high risk, even if it is one sector, it's certainly something to talk about. Give us a look. We'll do for you a Get Me to Retirement 5-step process. We'll talk about it. We'll find out what your goals are, review what you've done, and then figure out how's the income going to come? How much protection do we need? What are we going to do for growth? Give us a look on our website, which is retire210.com. Retire210.com. And if you've enjoyed this podcast and you want to hear more, hit that follow or subscribe button on your favorite podcast platform. And again, thanks for listening to the Clear Skies Retirement Podcast, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jamin J. Kirkwood, Texas Insurance License number 1421850.